Hi everyone, and welcome back to the channel. Today we will further explore the relationship between gold and US stocks. Remember my last video on the ratio between gold and the Dow Jones? The message was clear: in good times, equities are king. In unstable times, gold takes the wheel. And while the Dow Jones is already showing significant weakness against gold, the S&P 500, the flagship of the US financial sector, isn't quite there yet. The long-term trend line that the Dow Jones has breached hasn't even been properly tested. But when we look beneath the surface, the similarities to the 1970s are absolutely unbelievable. It's almost eerie. And the more I look into this topic, the more I'm convinced that gold prices will skyrocket in the coming years. To understand what's happening today, we need to rewind. After World War II, America experienced the ultimate bull run. This was the American dream in its purest form. At 25, you could afford a home, have a wife, 3 kids, and cruise through the suburbs in the latest Cadillac Eldorado. But in the mid-60s, the mood shifted. Massive social programs and the Vietnam War were eating up the budget. In gold terms, US equities saw a classic distribution pattern. And here's where it gets interesting. Until 1968, the price of gold was officially capped at $35 an ounce. So, the S&P gold ratio only stagnated back then because the denominator, gold, was artificially fixed while the S&P moved sideways. The demand for gold was massive, but the price wasn't allowed to breathe. Then came August 15, 1971, the Nixon-shock. Nixon closed the gold window and, temporarily, suspended the convertibility of the dollar into gold. So, technically speaking, we are still on the gold standard. It's just that the temporary measure has now lasted 55 years. Let's look at the last 2 decades. Interestingly, the low in the ratio wasn't in the 2009 crisis year, but in 2011. Why? Because a gold bull run doesn't necessarily need a stock market crash. The S&P rose by 60% during that time, but gold prices simply rose faster. Since 2011, stocks have outperformed gold, but since 2014, a distribution pattern has been forming. And that pattern is an exact copy of the one we saw in the late 60s. We've seen 3 major corrections in the S&P gold ratio chart over the last 10 years, 2016, 2020, and 2024. Pay attention to the details. We saw a higher high in 2021, followed by a clear lower high in March 2024. After the tariff crash in early 2025, there was a recovery attempt in the summer, which formed another lower high. Currently, we are retesting the support again, and there's a golden rule in technical analysis. The more often a level is tested, the likelier it is to break, whether it's to the upside or the downside. And now it gets really wild. Do you know which level we are currently testing? The 1929 high. I know, just hearing that number triggers panic for many. This level was already a massive support back in the 60s. If we take a bar pattern from the 70s and overlay it on our current chart, it's almost a perfect replication. Even that failed test of the 200-day moving average we saw last year, exactly what happened in 1972, just before the ratio collapsed and gold left everything in its wake. Unless something completely unforeseeable happens, gold will break this 1929 support again and outperform equities in the coming years. If you're thinking now, but what about the Fed cutting rates and restarting QE? Surely that's good for stocks. Please watch my last video on this. I explain exactly why that is actually fuel for the gold fire. If we follow the roadmap of the 70s, we are currently in late 1972. That would mean, what follows is a recession, an oil crisis, and 18 months of a non-stop sell-off in stocks. Stocks will not resume to today's prices until 2034, the beginning of a lost decade. However, history only rhymes. It does not repeat. And here's where I differ from the hardcore crash prophets. I don't think stocks will crash as hard as they did back then. Because the stock market today is the backbone of the retirement savings for the entire US population. It is the primary driver of wealth inequality. The elites will not allow a multi-year bear market to happen. They would rather flood the system with money until the printer glows red.
And there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
What this means for you: another massive wave of inflation is coming. More social unrest. a further hollowing out of the middle class. In a world where everything is being devalued, the only way is to invest in financial assets. And right now, gold seems to be in a prime position to capitalize from this. By the way, while writing this script, I stumbled upon another bizarre similarity to the early 70s. It has to do with Fed independence and this guy right here. But that deserves a video of its own. So stay tuned so you don't miss it. Let me know your thoughts on the current situation in the comments. And see you in the next one.